for something untoward to happen. The fat finger concept that people talked about pushing the wrong buttons on computers that led to the flash crash on May 6th. That could happen with a multiplier effect in the Forex markets if everything isn't completely coordinated. And we don't know that anything will happen that's bad. But when you start getting countries with conflicting interests warring with each other on a currency basis, you're building the platform for potential problems. Keep in mind, too, that the people orchestrating our QE2, Bernanke and so on, and on the Treasury side, Geithner, these were the people who were in charge of monetary policy in the period before and during the crisis that we just went through. They didn't do too well. And many of them were in power and in place and actually fueled the fire that resulted in the real estate boom and crash. They kept interest rates low for an extended period of time. Will they get it right this next time around? We don't know. But their track record up to now has certainly not been exemplary. Interestingly enough, just in the last week or so, there was a poll, a Wall Street poll, and the people responding to the poll said that they did not expect that QE2 was going to have any real appreciable effect on either the economy or the stock market. Now, they could be wrong too, but that at least was the expectation of the respondents to the poll. Let me turn now from the economy to the stock market. If you look over on page 24, stocks are at 1998, 1999 prices. You can see on the top graph we've got the top half we've got the S&P 500. On the bottom we have the NASDAQ Composite, and we're today where we were earlier this year, where we were in 2008 price-wise, where we were in 2004, 2001, and 1998. And except for intermittent rallies, stocks have not been the place to be invested for the past dozen or so years. As Carmen asked in the question earlier, and someone answered a zero return for that period of time, that's almost right on the nose. As she later gave the number, it's 13/100% per year annualized since the beginning of the century. And you'll see that the S&P 500, where it is right there, is still about 25% below its 2007 peak. And the NASDAQ shows a similar story. The years are slightly different across there, but the concept is the same, and that is even more. It's about 50%, a little more than 50% below its peak in year 2000. So this is a scenario that we began talking about back at the end of the 1990s. If you look over to the next page. I like constantly to get people to kind of keep this graph and study in mind. For those few who have not seen this, this is a study of two centuries, and it shows the alternating long weak cycles and long strong cycles over that 2-century time period. Interestingly enough, there's just about an equivalent amount of time in both the long cycles and the weak cycles. And these are inflation-adjusted numbers. So in other words, the inflation rate has been subtracted out here. And if you add up all the slight rises and the slight declines and so on in the weak cycles, you get to just about zero. So in the long weak cycles through 2 centuries, you've essentially earned back the rate of inflation, nothing more. Zero real return. Conversely, or on the opposite side of that, you see in all of the long strong cycles a double-digit return on an annualized basis, even after we've subtracted out the rate of inflation. So it's important to recognize we go through these things very regularly. This extended decline that we have been going through since year 2000 is not unusual. In fact, this one has only been going on for about a decade, the average of both the long and the weak cycles is about a decade and a half. That's the average. Now, you've got some that are shorter, you've got some that are longer, but the average is about a decade and a half. And the next page shows another picture of the same phenomenon. And it shows that this, by the way, is also adjusted for inflation, as they say up here. And it takes you back from about 1870 to present, so it doesn't cover the full 2 centuries. But it shows the 3 long week cycles before the current one that we're in. And without getting into too much detail, you can see on each of those, in each of the declines, you see how much it declined cumulatively over that time, and you see the number of months from the beginning of the long week cycle to the trough, not necessarily the end. Then it started recovering from there. And all of the declines are relatively similar, within a few percentage points. The biggest difference with this one is that it's only 108 months to the bottom in March of 2009. That if that marks the ultimate bottom, that will be far shorter than any of these 3 most immediately prior major declines. We did a summary much like this without adjusting for inflation at our annual client conference a few years ago. And we also identified the characteristics of each of the major market bottoms that were, and by the way, each bottom is not necessarily the absolute low point in here. Sometimes you'll see, as for example in this one, we were still in a pretty long decline, but it was up from the earlier lows. It's just still part of that long week cycle. So if we do this again, it doesn't mean we have to go below this earlier level. It could, if it comes down, it could come down somewhere in there perhaps, and still be at least in sync with the earlier studies here. But the characteristics that typified each and were easily observable in each of these earlier long week cycle bottoms were, first, stock valuations were extremely cheap. Second, the volume of trading was usually a relatively small at the bottom of the long week cycle as compared to where the cycle began. And the third was that investors had almost completely lost interest in stock ownership, and that phenomenon continued for a period of several years after that. I pointed out, while we anticipated that somewhere in here there was going to be a pretty good rally, that none of the characteristics of the prior long-term cycle bottoms was present either in year 2002, 2003, the first big dip down, or in 2009. We did not see dirt cheap valuations, as we'll show in just a couple of minutes. We did not see volume really collapse. In fact, the volume was very, very heavy at the bottom in 2009. And though there was a short-term reduction in desire to own stock, that ownership desire was rekindled very quickly within the first month or two, and you started to see very positive confidence statistics show up. So we did not see them. Now, that doesn't mean that this time couldn't be different from the others. It could. It always can be different. There's a worrisome modern precedent on the next page, and that is the Nikkei average. We see here that average shown from 1988 to present.